So hello and welcome to the Jefferson Educational Society's digital programming. I'm Ben Spagan and I'm a vice president at the Jefferson and I'm a contributing editor at the Erie Reader. For this program, we welcome renowned financial experts from the Reinvestment Fund who will focus on reverse mortgages and the impact of the COVID-19 pandemic. Now they're going to review Erie-specific data and maps on reverse mortgage lending in their presentation, which is designed to help seniors better understand the complexities, risks, and advantages of reverse mortgages. They're also going to discuss new rules that protect seniors with a reverse mortgage from foreclosure and show data about who borrowed with reverse mortgages in the last recession and where many reverse mortgages eligible seniors live today. Now, this research and presentation are thanks to Dr. Ira Goldstein and Dr. Michael Norton and attorney Colin Weidig. No stranger to the Jefferson, Ira actually appeared previously as part of the inaugural Metro 100 in 2015, along with urban renewal expert Bruce Katz and Brookings Institution senior fellow Mark Moreau, addressing the issue of equitable development and the role of advanced industries in the 21st century economic development. A bit on each of the experts. Dr. Ira Goldstein, president of the Community Investment Group Policy Solutions at the Reinvestment Fund in Philadelphia, has conducted statistical analyses in many cities and regions across the country designed to be used by local governments to craft policy responses. For more than 25 years, he has been a lecturer for the University of Pennsylvania's Urban Studies program, specializing in research methods, statistics, and housing policy. Now, Dr. Norton is a chief policy analyst at the Reinvestment Fund, and he works closely with a range of partners, including some small nonprofits, local and national philanthropies, private companies, colleges, and governments. And attorney Weidig, a senior policy analyst at the Reinvestment Fund, is currently working on researching the impact of reverse mortgages on the Philadelphia area, analyzing the number and geography of evictions in Philadelphia, and conducting a market value analysis of Denton, Texas. Now, folks, since this program is first airing live on the Jefferson's Facebook page, we're going to work our way through as many questions from you, the viewers, as we can as we host this event. If you have a question, just leave it in the comment section below, and we're going to get those to today's presenters. Now, a unique experience for us the first time at the Jefferson, you're going to find Dr. Norton there actually hanging out in the comment section as well, so you might see some back and forth engagement there. We encourage you to type in your question. If you happen to be watching a later broadcast of this, please still do send us your questions and comments, and we're going to do our best to get them along to these experts at the Reinvestment Fund as best we can. And of course, for more information about both past and upcoming Jefferson Educational Society programs and publications, please visit our website, jeserie.org, and like us on Facebook and follow us on Twitter and Instagram, and subscribe to our YouTube channel. Gentlemen, enough from me. Thank you, though, for all joining this program.
Thank you. Thanks for having us, man.
All right, so Colin, I'm going to go ahead and make you a co-host for this event. That way you can go ahead and start sharing the presentation. We'll work our way through the slide deck. Again, folks, we're going to take questions from you, but we're going to let Colin hit the ground running, get through a good chunk of the first half of the presentation, and then we'll jump in with a few questions there midway, and then we'll circle back at the end for questions for a Q&A session. Colin, over to you.
Great. Thanks very much, Ben. So as Ben mentioned, Ira, Mike, and myself come from an organization called Reinvestment Fund, which is a community development financial institution located primarily in Philadelphia, but also with a couple offices in Baltimore and Atlanta. What it means to be a community development financial institution is that we are essentially a lender for a public purpose. We make loans to build wealth and opportunity in low wealth communities for a whole range of things that build strong and equitable communities, including things like affordable housing, early childhood education seats, and green energy, amongst many other things. Ira, Mike, and myself are part of the Policy Solutions Group, which is a group within Reinvestment Fund that both looks at the impacts of reinvestment funds loans in the communities where we do our work, as well as does work for outside organizations who are interested in looking at the impact of their policy initiatives, or to gather data and do some assessment of important policy issues in their community. As part of that, for many years, we've done work throughout Pennsylvania on the lending market, and in Philadelphia specifically on the impact of different lending products on communities throughout Philadelphia. And during the last recession, we were doing some work evaluating a mortgage foreclosure diversion program. And we noticed that many reverse mortgages were entering this mortgage foreclosure diversion program, attempting essentially to work out something between the homeowner and the lender to resolve the foreclosure action. At the time, that was confusing for us because we didn't know much about reverse mortgages besides the fact that the homeowner was receiving money from the lender. And so what was confusing was that we didn't understand how a product where the homeowner is receiving money could end up in a foreclosure action. Being policy geeks, we decided that the first thing to do was to map the data that we had about reverse mortgages to better understand what was going on throughout Philadelphia. And we made this map, which was sort of our introduction to the reverse mortgage world. This is a map of reverse mortgage foreclosures throughout Philadelphia. The underlying layer there is the racial distribution and ethnic distribution of the city of Philadelphia. The areas that are in darker shades are those where more African-American residents live. The dots each represent one reverse mortgage foreclosure in the years between 2008 and 2012 in Philadelphia. The size of the dots correspond to the filing amount for the foreclosure, or basically the amounts of the principal for the reverse mortgage plus some filing fees.
Colin, could I ask you one question? Would you be able to share your screen with us and work through that, so that way the folks at home can catch that?
Are you not? Oh, I see what I didn't do right. Can you see my screen now, Ben?
Perfect. I can see it now. So if you want to go ahead and keep going, that's where we can see those dots. Come back to that. That would be fantastic. Thanks,
Perfect.
Colin.
Sorry about that technical difficulty.
Oh, that's okay.
Thank you. So here's the map that I was just referring to. And to orient you again to the map, this is a map of the city of Philadelphia. The underlying shading layer represents the racial and ethnic distribution throughout the city. The darker areas are those with more African-American residents. And each of the green points represents a reverse mortgage that went into foreclosure. The size of the dot represents how much the underlying loan was that went into foreclosure. So the smaller dots are for reverse mortgages that were principal amounts less than $50,000, and the larger dots are for $200,000 or more. And so when we mapped this data, what really stuck out to us was that there was a clear racial pattern to where the reverse mortgage foreclosures were occurring in the city of Philadelphia. You see many more reverse mortgage foreclosures in areas where many African-American residents live. Secondly, you see that very many of those dots are the smallest that represent $50,000 filing amounts or less. So in these cases, you're talking about a senior-headed household that was in danger of potentially losing their home for amounts of money that are relatively small. So this was sort of our introduction to the world of reverse mortgages, and it made us want to look further into the issue and understand what went wrong in these cases that senior households in Philadelphia were in danger of losing their home for amounts of money that could be less than $50,000. And so we partnered with a fair housing organization in the area called the Housing Equality Center and got a grant from the U.S. Department of Housing and Urban Development to look further into the issue, first with data to understand the issue and what was going on, and then to do some testing of reverse mortgage lenders throughout the area to understand if there was some differences in the way that they were treating folks in different neighborhoods throughout Philadelphia. So the plan for this presentation is first to talk about what we learned about how reverse mortgages work, both what some of the good uses are for reverse mortgages, as well as what some of the uses are that can cause seniors to run into the trouble that the seniors that are represented on this map ran into. And then second, we'll discuss what we found with the data examination about the patterns of reverse mortgage lending throughout the Philadelphia area. Finally, we'll talk a little bit about what the data shows across Pennsylvania and in Erie specifically about where reverse mortgage lending has happened throughout the state and some places that you might expect it to pick up in the next few years. So first, let's start with a reverse mortgage 101. And sometimes we're going to use the term HECM for a reverse mortgage. Almost all reverse mortgages are federally backed by the FHA. And so they're sometimes called home equity conversion mortgages. That's for all reverse mortgages that have a principal of less than $675,000. So if you hear the term HECM, that's interchangeable essentially with reverse mortgages. It means a federally backed reverse mortgage. So to orient you to how reverse mortgages work, let's just do a quick refresher on how traditional mortgages work. If you look at the icons on the bottom of this slide, this represents the typical process for a traditional mortgage that I'm sure many of the viewers are familiar with. So the homeowner in this case starts with a small amount of equity that's usually the down payment. That's represented by those green bars. And they have a much larger debt that's taken out as a mortgage against the home when they first purchase it, and that's represented by these blue bars. As we go through time, which is as we go from left to right on this line, you see that the homeowner is making their mortgage payments and they're building equity over time. The debt is decreasing over time, and eventually they're going to own that home free and clear of any mortgage debt having made their payments. That's a traditional mortgage. As you might expect, a reverse mortgage works essentially the opposite of that. So in this case, the home equity is the predominant amount of financial resources in the home. A reverse mortgage sometimes works where the homeowner owns the home completely free and clear of any mortgage debt, although sometimes homeowners have some remaining traditional mortgage debt that they want to pay off with a reverse mortgage as well. And what happens is that instead of the homeowner sending payments to the lender sends payments to the homeowner in return for their equity. And as you see, as we go from left to right on this graph, the debt starts building up as those payments are made to the homeowner, and the equity continues to decrease. So that's the most important first step in reverse mortgages. There's also a really second important factor with reverse mortgages, which is that when a borrower borrows with a reverse mortgage, even after all the reverse mortgage proceeds are gone, they're entitled to live in their home throughout the rest of their life, so long as they remain in good standing on the reverse mortgage. So that's something a little bit different than a traditional mortgage. That's an extra right that comes with a reverse mortgage and has a lot of important implications for how senior homeowners plan when they borrow with this lending product. Another important difference that I think sometimes isn't as clear right away is that even after those reverse mortgage proceeds are gone, principal amounts have interest accruing to them, just as in a traditional mortgage, you accrue interest amounts over time. So even after the homeowner is done receiving payments, there can be interest amounts that are increasing on the reverse mortgage. And so that debt can still be growing even though the homeowner is not getting any more money. And that's what's happening in those sort of last two icons on this slide. You don't see any dollar payments going to the borrower, but because the interest increases on the principal amounts, you're still seeing increasing levels of debt and decreasing levels of equity. As I mentioned, some people are curious about if they have a traditional mortgage, can they still borrow with a reverse mortgage? And the answer is that they can. The two important qualifying factors for a reverse mortgage are being age 62 years of age or older, and having sufficient equity in the home to support the loan. So even if someone has a little bit left on an existing mortgage, but they own most of their home, their home is predominantly equity, they're still able to borrow with a reverse mortgage. And in fact, that's a common use of reverse mortgages, is to pay off a little bit of traditional mortgage that's left and then take the rest of the reverse mortgage as proceeds to the homeowner. So the next question is, how much can someone borrow with a reverse mortgage? And there's a few important factors that influence how much can be borrowed at one time. Although the eligibility age is age 62, the older the homeowner is, the more they can borrow with a federally backed reverse mortgage. And that's because this is a federally backed product, so the older a homeowner is, the less risk essentially they represent to the federal insurance, and so they're able to borrow more at one time. Obviously, the interest rate is going to affect how much somebody can borrow. So we're in a very low interest rate environment currently, which means that people will be able to borrow more against their home. And finally, just the amount of equity in the home is going to influence how much the borrower is able to get in proceeds from a reverse mortgage. There are a number of upfront costs with reverse mortgages, which is similar to traditional mortgages. They typically range somewhere from $2,500 up to a statutory maximum of $6,000. That's the most that a homeowner can be charged to borrow with a HUD-insured reverse mortgage. Homeowners make different decisions about whether they want to pay those costs out of their own pocket or use some of the reverse mortgage proceeds to pay off those upfront costs. If they do choose to use reverse mortgage proceeds to pay those costs off, however, that's less that they can get in total benefit. As you see on this second house icon, those hatched bars represent the upfront costs paid out of the proceeds of the reverse mortgage. So those also become debt on the home, just like the other reverse mortgage proceeds. If someone is thinking about selling their home while they have a reverse mortgage and they're curious, how much can I get for my home when I have this reverse mortgage? The real question is, how much is the principal of the reverse mortgage? So like any other mortgage, when you go to sell your home, you're able to take whatever equity you have left after you pay off the principal amounts on the mortgage. And so it becomes very important as you're planning over the long term about what you want to do with your home to think about how those principal amounts have accrued and how much the interest has accrued over time, so you can understand how much equity remains in the home if you're making a decision, for example, to sell the home and then move into a senior residence, or you have some other use for that equity that you're planning over time. You really want to think about the long-term effects of how will the reverse mortgage interest and principal grow over time, and what equity will that leave me in the home before I'm able to leave and make some use of the equity in the home. So as we mentioned, one of the really big features of a reverse mortgage is that it allows the homeowner to remain in their home until they pass away, or until they choose to leave it for some other reason, like selling it or moving into a senior residence or something of that nature. So when any of those things happen, the homeowner can pass their home on to an heir, just like with any other lending product, so long as there remains some equity in the home. So if the homeowner has half the equity in the home and half the rest of the value of the home is in reverse mortgage debt, then essentially the heir would inherit the home with that reverse mortgage debt. And if they wanted to sell the home, they would first have to pay off the reverse mortgage, and then they could benefit from whatever remaining equity was in the home. They can also take out a loan themselves, or if they have the means, just pay off the reverse mortgage directly and own the home as they would normally. If the reverse mortgage principal amount exceeds the value of the home at the time that the homeowner either passes away or chooses to leave, then the heir can only be charged up to 95% of the appraised value of the home. The rest is covered by the mortgage insurance premium by the federal government. So that's a really important factor. If a homeowner passes away and they still want to pass their home on to their children or a caregiver, that person can't be charged any more than 95% of the appraised value of the home, even if those reverse mortgage amounts have increased over whatever the appraised value of the home is at the time. If there are two spouses in the home and only one chooses to be on the reverse mortgage, which sometimes happens because the age of the borrower is one of the factors for how much can be borrowed, the spouse who isn't on the loan, who is in reverse mortgage terminology called the non-borrowing spouse, has some really important rights that they need to be aware of for any reverse mortgage that's been made from 2015 on. So if you're thinking about a reverse mortgage now, these rights would apply. What happens for the non-borrowing spouse is that they essentially get the same right to live in the home until they pass away as the borrowing spouse does, but they have to notify the lender that that's what they intend to do at the time that the loan is taken out, and then every year thereafter for as long as they remain in the home. So that's something that you really have to be cognizant of, because you're talking about doing a yearly notice to the lender that the non-borrowing spouse intends to stay in their home for the rest of their life or however long they do. That includes if the borrowing spouse predeceases them or leaves the home for any other, well, at least it includes if the borrowing spouse predeceases them. They can still remain in the home as long as they're continuing to notify the lender that that's what they intend to do. So those are the basics of reverse mortgages, how they work and what some of the most important rules are. Now I'm going to talk about how people think about reverse mortgages. So what are some of the most beneficial uses and what are some of the concerns that people who work with seniors who have gotten reverse mortgages talk about running into?
Hey, Colin, if I could sneak a question in real quick before you move on there, just curious, what's included in a financial assessment, for potential reverse mortgage borrowers. Maybe you're going to get to that in a bit, but just curious about that here.
Yeah, that's a really good question, Ben. So another recent rule change, in addition to the surviving spouse rules that we talked about, is that now there's a financial assessment that goes for the homeowner when they're thinking about borrowing with a reverse mortgage. So if you think about a traditional mortgage, usually you go to a lender and the lender runs a credit check, and that's how they determine if someone has sufficient income and credit to take out a traditional mortgage. With a reverse mortgage, there's no credit check. The things that are checked are whether the borrower is 62 years of age or older, what the amount of equity in the home is, and then finally, whether the borrower has the wherewithal to keep up with financial obligations that happen throughout the life of the loan. So those include things like property tax, being able to maintain the property in good condition. And basically what's checked is all the sources of income that the person who's thinking about getting the reverse mortgage has on a monthly and yearly basis. So things like Social Security, pensions, or 401k amounts. If the borrower doesn't have enough money to support all those things like paying taxes and insurance, then they can use part of the reverse mortgage proceeds and put them essentially in a set aside or lockbox that's used to pay those amounts off during the life of the loan. And so that's a really important consideration for the borrower to understand how much they can benefit over the life of the loan if some of those amounts have to go into that lockbox.
Thanks, Colin.
Sure, thanks, Ben. So that brings up the advantages of a reverse mortgage. One is that non-traditional qualifying. Instead of having to get a credit check, the most important thing is that there is sufficient equity in the home to support the reverse mortgage. So for people whose credit might not be sufficient to get something like a home equity line of credit, they can still qualify for a reverse mortgage. Lots of borrowers like that there's no monthly payment, unlike in a traditional mortgage where you're making payments to the lender. Instead, you're getting money, and so that changes essentially what your monthly balance sheet looks like, gives you a little bit of extra money to do things with. You can tap into equity. There's only a few products that allow a homeowner to tap into the equity that they've built up in their home throughout the years. And so that's an important consideration. And then finally, that ability to live in their home until they die or until they decide to sell the home or leave it for another reason. Some of the most common things that people use reverse mortgages for are, one, like I just mentioned, to just supplement their income. So to have a little bit more money every month or every year that they can plan and know, I'm going to have this increased income to do, the various things that I want to do with my income throughout my senior years. And another really common use is to make major capital expenditures where you might not have all the capital otherwise. Those can include things like to redo parts of your home, like say redo your kitchen or make your home more accessible as you age into senior years, or to pay major medical expenses. When you're thinking about how to borrow with a reverse mortgage, there are three main options. One option is a line of credit, which works similar to most lines of credit, where there's a principal amount that sits there, and then the homeowner can draw on that principal whenever they decide to and in the amounts that they decide to. So they can draw a little bit of money in 1 year, wait a few years, and then draw a lot more money however they'd like. The important thing about the line of credit is that interest runs on the line of credit just as it would on principal of a loan. And so if the homeowner takes out a line of credit and then they wait to take some of that principal amount out, their principal will grow over time at the interest rate of the loan. That's usually an adjustable rate. So you'll get the benefit of whatever rates if they adjust up. Another common use is the one we just talked about getting either monthly or annual disbursements from the principal amounts. which is really nice if a homeowner wants to plan ahead and they think I can add this extra $200 a month to what I get, with my usual Social Security or pension amounts or whatever other income sources they have. So that lets the homeowner know that for, X number of months or Y number of years, I can count on receiving this extra amount of money. Finally, their last use is as a lump sum, where the homeowner takes out as much as they're allowed by those principal limit amounts in year one, and then any remaining amounts in the second year of the loan. And this is the use of reverse mortgages that has drawn the most policy attention because it's a little bit more risky from a financial perspective. It can run into situations where the borrower, if they're younger, can end up running out of those funds because they might not have planned for how long those funds will last them when they draw them all at once. It's also a more expensive product because all the money is coming out of the loan pretty shortly after the loan is taken out in those first couple of years. So it's associated usually with a higher interest rate as well as a fixed interest rate. So if interest rates adjust to the benefit of the homeowner, they don't get that benefit because it's a fixed rate. So we started by talking about those homeowners in Philadelphia who ran into some trouble with reverse mortgages and ended up in foreclosure. And these are the most common reasons why seniors with reverse mortgages can end up in defaulting on the loan and even ending up in foreclosure. The number one reason that we see, especially in Philadelphia, is for unpaid property taxes. And this can be a source of confusion, I think, for a lot of seniors who borrow with reverse mortgages. If you think about a traditional mortgage, you make that one payment to your lender, and usually not only your principal and your interest, but also your taxes and insurance are all included in that one payment. It's not necessarily the case with the reverse mortgage unless you specifically ask the lender to use some of the proceeds to pay off taxes and insurance. And so sometimes homeowners don't understand that those amounts they're getting aren't after taxes, and then at the end of the year they get a bill from their local municipality for a whole year's worth of taxes. It can be a lot of money for homeowners who are on a fixed income to come up with all at once. And in that case, the lender will advance monies on behalf of the borrower, but if the borrower can't raise all that money at once, it can result in a default and a foreclosure. Similarly, with homeowners insurance, the borrower has to remain current on their homeowners insurance throughout the life of the loan, including if those reverse mortgage proceeds are gone and the homeowner is remaining in their home with that life estate benefit. You still need to maintain homeowners insurance the whole way through. Because the home is collateral for the loan, one of the requirements is that the home remains in good repair. So if there are some repairs that are needed, that the reverse mortgage lender or servicer does a window inspection of the home and they see, oh, there's some repair needs here and the homeowner doesn't have the funds to make them, then usually the borrower will have to engage someone, or excuse me, the lender will have to engage someone to make those repairs, in which case it can result in a reverse mortgage default. Finally, it's a requirement that the borrower lives in their home as their primary residence for at least 6 months of the year while they're borrowing with the reverse mortgage product. So if they have to leave their home for more than 6 months, that's a technical default on the loan. And that can include even leaving the home for long-term medical care in some cases that we've seen in Philadelphia. So it's really important if for any reason the homeowner is thinking about borrowing with a reverse mortgage, but they don't want to live in their home for 6 months of the year, they've got to talk to the lender and figure that out before they borrow with the product. So those are some of the things that can go wrong. Here's some of the things that can go right. And this is what sets a borrower up for success with a reverse mortgage. The number one thing is that, as we've talked about through the first 20 minutes of this program, there's a lot of rules. It's a fairly complicated lending product. And so it's really important that the borrower have a strong commitment to understanding the rules and how they apply to their situation. That can often include thinking long-term about what their plans are for their home and whether they want to pass their home on to an heir or someone else. They want to make sure that they get that person involved in the process as early as possible so that they can make sure that the home is used the way that the household wants over the long term. It's also important to have a really good understanding of what your income and liabilities are and your other assets so that you can know you won't run into any trouble with the reverse mortgage. As we mentioned, there is that financial assessment, which is helpful in having some peace of mind to understand that, like, yes, I do or don't have sufficient income and assets, but it's really incumbent upon the borrower to make sure in the long run that they have what they need to make sure that the reverse mortgage is in good standing for as long as they want to remain in their home. So as part of our investigation, we talked to a number of borrowers to try and understand from their perspective, having gotten this product and then had an experience with it, what were their concerns as they looked back on the lending experience? Their number one concern was that they just didn't really understand the rules as well as they thought they did when they took the lending product out. There is, as part of the reverse mortgage lending process, required HUD mandated counseling. And so anyone who's thinking about borrowing with a reverse mortgage will get a list of housing counselors that they can either call or visit to get a description of all the things that goes into the lending product. But some of the borrowers we talked to still felt like even after that process, they just didn't understand the product as well as they would have liked to. And so for anyone, again, who's thinking about borrowing with this product, we really encourage you to visit a housing counselor who can really holistically look at your income and your assets and your long-term plan for your home and give you some really solid advice about whether this is the right lending product for you. There was a lending issue in the last recession in Philadelphia where repair contractors were essentially going door to door, soliciting people and saying, we'll do these repairs to your homes, things like we'll redo your kitchen and you won't have to pay anything for it, just sign these documents. And that's a really concerning lending pattern. Often the people who signed the documents didn't understand exactly what they were getting into. And so for people who work in the policy space, when you see that going on, that's a red flag that you want to look deeper into who these contractors are and who the lenders are that are backing them. Some of the borrowers we talked to said that reverse mortgage lenders were really friendly with them and they had a great relationship. The lending process was smooth, but when they ran into a little bit of trouble, maybe because they had a problem with their taxes, the servicers were not as friendly. And they had a lot of trouble working with their servicer to just come up with a repayment plan to pay back those taxes, because they said, look, I want to make up the taxes amounts because I know that's my responsibility, but I need to pay that over several months instead of having to make all those payments at once. So also for people who are working in a policy space, it's really helpful if you know reverse mortgage borrowers who are having trouble working with their servicer to get them to a housing counselor or a legal services agency sooner than later so that those folks can help them work with their servicer and come up with an effective repayment plan or some other way to avoid a reverse mortgage foreclosure. And finally, sadly, in some instances where folks hadn't really planned for the long term, we've seen instances where widows or heirs were unable to keep the family home because maybe they didn't do all those required notifications for a spouse who's not on the reverse mortgage, or by the time that the heir got to the home, there was so much reverse mortgage debt that they just weren't able to qualify for another mortgage to pay that back. So the earlier that you can involve those folks in the process, the better they're going to be able to keep the family home if that's their objective. We made a reverse mortgage calculator that I'll share with Ben so that he can put up online for anybody who's interested. It's something where you can add a few details like the age and the value of the home, and it'll give you a sense of what total amounts you can benefit from a reverse mortgage. It'll also give you a sense of how long the proceeds will last, depending on how you take those disbursements, and how that compares to the overall value of the home over time. So one last consideration, obviously we're living in a pretty different world than we were just a few months ago, and that has had really big ramifications for the reverse mortgage lending world as well. HUD declared a 60-day foreclosure moratorium for all reverse mortgages. That's now been extended through the end of this month, August 31st, as well as statewide, there's a foreclosure moratorium that is also right now through August 31st. Those are important things to keep an eye on in case they get extended again. for anyone who's working with a borrower who has a reverse mortgage and might be having some financial difficulties. There's also a mandatory 6-month forbearance period right now for any reverse mortgage that goes into a technical default, with an additional 6 months forbearance if the borrower requests after the initial 6 months. So up to a year's worth of forbearance, as long as that second 6 months is requested. So those are really important things for anyone who's working with a borrower who's having a little bit of trouble with their finances and a reverse mortgage to know. Also important is that HUD has asked reverse mortgage servicers not to do any negative credit reporting at this time if a borrower is having financial trouble with a reverse mortgage.
So Colin, right before you get into the Pennsylvania data, and I know we're curious to see what you found in Philadelphia, you and Ira and Michael. Michael's over in the comment section on Facebook as we're doing this event live. One of the events, one of the questions that did come up so far in the event, I know you covered concerns as well as common uses, but what about suspect uses? When people actually try to use this, there may be some concerns of why they're using it. A couple of folks are asking about that in the comment section.
Suspect uses. So I think one of the things we've seen is sometimes a rapid refinancing where you'll see several reverse mortgages taken out in a short period. So you'll see one in 1 year, and then a year later another one, and in the third year yet another reverse mortgage. And sometimes that's because it's in areas where the home values are rapidly increasing. And so those are kind of a strange use of the product, because each time the borrower is essentially paying those upfront costs, and they're not getting the full benefit that they would have gotten if they had just waited until year 3 and taken out one reverse mortgage. So rapid refinancing is always a suspect thing in the lending world, and that's a thing to watch out for. As I mentioned, really that connection with contractors who are doing maybe door-to-door solicitation. That was something we saw in a lot of the neighborhoods where there's reverse mortgage foreclosures in Philadelphia. And so that's a pattern that was really predominant, especially during the recession, when a lot of senior households maybe didn't have as much income. And so it was being presented to them as a way to, say, redo their kitchen without having to pay much more money. That's something that people who are helping seniors should really be on the lookout for.
Yeah, and that's such a startling and surprising story. I think where folks might not expect to hear something like that somebody's out there actively using a product like this to take advantage of those who might be more vulnerable in our community. So when it came to learning about reverse mortgage lending markets in Pennsylvania, Colin, what did you and your team find here? Sure.
So I'm going to give you just a little bit of background to start out about what reverse mortgage originations look like in Philadelphia. The product was created in 1982 by Congress, and in Philadelphia, there really was very little reverse mortgage lending until the mid-2000s. So you had almost 20 years where the product existed, but there were almost no loans made. And then the product really shot up at a time of increasing home values in Philadelphia, which was the sort of mid-2000s, say from 2005 to 2008. And its most active period was during the last recession. So from, say, 2008 till 2011 or 2012. That's when you saw the most reverse mortgages in Philadelphia, and also in Pennsylvania. And so that's why we suspect a little bit that with the current financial trouble people are experiencing, you might see a big increase in reverse mortgage lending, especially in some of the most vulnerable places where people really are in need of some extra financial resources. This is a look just at Pennsylvania. You can see that the peak number of reverse mortgage originations was in 2009 during that recession period. And there's been a pretty steady decrease. There's been very fewer of these loans made throughout the state. Pennsylvania in the last recession was one of the most active reverse mortgage markets throughout the country. It was somewhere usually 4th or 5th amongst states in number of reverse mortgages being made. That's in part because Pennsylvania is just a little bit older as a state. There's more seniors living here. And that's also a reason why we suspect that it's possible reverse mortgage lending could really come back in a big way in Pennsylvania. This is a county level view of where reverse mortgages were originated across the state in 2018 and 19. So the darker shaded counties are those that experienced the most reverse mortgage lending in 2018 and 19. And the lighter shaded are those that experienced less reverse mortgage lending. It looks like Erie is maybe a little bit more reverse mortgage lending than average across the state in 2018 and 19. When you adjust for the population of folks that's 65 or older, you see that the picture looks a little bit different. Some of the places that were lighter, like especially in the northeast part of the state, get a little bit darker here because there's more of a concentration of reverse mortgage lending in those places. For Erie, though, you still see that Erie is a little bit higher than average for a county in Pennsylvania for reverse mortgage lending. Not the highest, but a little bit higher than average. This is a zip code level view of reverse mortgage lending in Erie County and Erie City from 2000 to 2019. So this map works the same way, where the zip codes that have those darkest shadings are those that experience the most reverse mortgage lending in that time period, and the lightest shadings are zip codes that experience less reverse mortgage lending. You can see there's a cutout of the city of Erie at the top left there so that you can get a little bit closer view of what's going on in the city. There's a kind of interesting pattern here where all around the edges of the city are where you really saw the most reverse mortgage lending in Erie. So I'd be curious, Ben, maybe I can throw it back to you. Maybe as someone who knows the area well, is there anything about those areas that you think might be a place where reverse mortgage lending is more predominant?
I wonder if maybe age plays a role in that, in the demographic. You're seeing that ripple out from the downtown core. So you may in fact see a younger population concentrated in the core. You may also see a more diverse population concentrated in the core. And Colin, I know one of the things that you were talking about is the disparities sometimes when it does come to race, when it comes to people applying for any type of loan. This is not just limited to a reverse mortgage, but we see it evident there too. This has, in some ways, disproportionately affected people of color not being given more information about these loans or being coached through the process as perhaps a family in very similar circumstances that happens to be white. So that may also be a reason that that's playing a role there.
Yeah, that's a great point, Ben. And that's one of the things that we looked at when we gathered all that data for Philadelphia and the 5 surrounding counties, or excuse me, 4 surrounding suburban counties. We looked at the characteristics of the reverse mortgages and the people that were receiving the reverse mortgages in that area. And what you see is that in the city of Philadelphia, the reverse mortgages were really quite different from those you saw in Bucks, Chester, Delaware, and Montgomery counties. The column that I'd really point you to on this slide is the interest rate column and the fixed rate column, which shows that Philadelphia had almost 60% fixed rate loans, and they were at an interest rate of 5%. So basically 1.5% higher than the interest rate in the surrounding counties. And what that really shows is that in Philadelphia, there were lots of those lump sum structured reverse mortgages where people were borrowing as much money as possible right away, maybe running out of money later and coming into some trouble with the reverse mortgage foreclosures. But those were very different in Philadelphia than in the surrounding counties, where you saw a much lower interest rate and much more likely to be a line of credit or a monthly or annual payment structure. When we looked at the race of the people that borrowed reverse mortgages, you see that in every county that we looked at, African-American folks were much more likely to borrow with reverse mortgages than you'd expect based on the racial composition of the county. That included Philadelphia and the surrounding suburban counties. So the dark blue bar on this graph is the share of reverse mortgages that went to African-Americans. The light blue bar is the share of homeowners who are African-American in that county. And the gray bar is the share of the population who's 65 or older, so basically a proxy for reverse mortgage eligible age, who is African-American in each of these counties. So you see that that dark blue bar that represents the share of reverse mortgages to African-Americans exceeds those other bars in every single county. And in Philadelphia, it was almost twice as likely for an African-American household to receive a reverse mortgage as you'd expect based on their share of homeowners or their share of folks age 65 or older in Philadelphia. But that was true also in suburban counties like Montgomery County and Chester County. This is a map of where all reverse in Philadelphia from 2008 to 2016. Each of those dots represents 3 reverse mortgages. And similar to that very first map that we looked at, the shading and hatching represents the racial and ethnic distribution of Philadelphia. So those darkest shaded areas are those in which many of the residents are African American, and the hatched areas are those in which many of the residents are Hispanic. What you see is that the reverse mortgage lending was really concentrated in a few African American neighborhoods in Philadelphia. If you look up at this West Oak Lane label, you see just a ton of those dots that each represent 3 reverse mortgage originations. That is a traditionally middle-class African American neighborhood in Philadelphia. So one in which there's, equity to support a reverse mortgage, but you also see lots more lending there than some of the traditionally middle-class white neighborhoods that are nearby, like Roxborough and Manayunk. And just to put some numbers behind that, in neighborhoods that were 20% or less African American in Philadelphia, up even to 60% or less African American, in that time period, we saw 8 reverse mortgages per neighborhood. As the share of residents who are African American grew to 60 to 80, or even 80% or more, you just see a huge increase in the number of reverse mortgages that you saw in those areas. So that in neighborhoods that were 80% or more African American, you're seeing 3 times the level of reverse mortgage originations that you see in those neighborhoods that are less than 20 or less than 40% African American. So we did see a clear racial pattern to the lending that was going on in Philadelphia. As we look forward and want to think about what are some of the places that might experience reverse mortgage lending in coming years, Pennsylvania, as I mentioned, is a little bit older state in terms of the share of the population that's 65 or older. But this shows at a county level the share of residents who are 65 or older. The darkest shaded counties are those that have many residents that are 65 or older. Erie has relatively few residents who are age 65 or older compared to the state at large, but still a pretty typical share of residents who are 65 or older compared to the nation at large. The next group that you might want to take a look at are people who are about to become of reverse mortgage eligible age. So many baby boomers are about to retire and they're thinking about their finances, and they are approaching that age 62, or for a few of the folks on this map have already reached that age 62. And again, we see Erie is a little bit lower than the state as a whole in terms of the folks that are about to reach that reverse mortgage eligible age. But still, if you put those 2 numbers together, you're talking about close to 30% of the residents in Erie who are either already reverse mortgage eligible or will become so in the next 5 to 10 years. So this could become really a quite important issue for the Erie community at large. With that, I'll stop and take any questions that folks have, either about how reverse mortgages work or what we learned with some of that data collection that we did.
Colin, that was fascinating. I can't thank you and the team there, Ira and Michael, enough for putting that all together. And we have some questions, and I don't want to get through them. I'm going to use my own family as an example here, and I'll use my mom, because she's seen commercials of celebrities discussing reversed mortgages and why they're a good thing. My mom uses the language, well, it sounds like it's too good to be true. Mm-hmm. And so when we think of that, and we think of, those who are eligible, seniors taking a look at that, can we talk a little bit about how this may seem like it sounds like it's too good to be true, when they're either hearing from celebrities or, perhaps, back to your example of the contractors, being taken advantage of, just the idea that this doesn't always make sense clearly as you've explained it here in this presentation.
Yeah, I think that there's really both some very good and some very poor uses of this lending product. And so it really depends on, for example, for your mom, what is her long-term plan for her home? Does she want to benefit from a reverse mortgage and then she's willing for the home to go back to the bank at the end of her lifetime? Or is it something that she wants to pass on to you or other family members. And that's really an important consideration to plan for at the beginning with a reverse mortgage, is to make sure that the long-term view is still kept in sight. There are certainly good uses of reverse mortgages. We talked to some great researchers at the American College for Financial Services who talk about taking out the line of credit as essentially a hedge against other risks that you might have in retirement. So, if, for example, you're relying on a stock portfolio and that was going to possibly decrease with some uncertainty right now, a reverse mortgage can act as a hedge against that. But that's for someone who's like a very high net worth individual who's probably working with a financial advisor to consider all their ways and means essentially in retirement. Another really good use that some people that we've talked to talk about is for folks who they're not planning on passing their home on to anyone after they pass away. And so they can use those dollars to do a few things in retirement that they might not have been able to do. So we talked to one family where the children all were financially fine and they weren't planning on inheriting the home. And so their parent was able to use that equity to go to the diner every day and not have to make breakfast, right? So the really important thing I think we would say is that there are good uses of the lending product. You just want to make sure that you talk to someone who's neutral and who can give you the best advice about whether it's a good fit for you, one, and two, think long-term about what are you trying to accomplish with your home and what are your trade-offs there.
And one of the things, Ira, you had mentioned this in the chat function, the idea of the predatory loans of the late 90s and early 2000s. I love your phrasing there. When the money comes looking for you, the chance of being taken advantage of is likely greater. And so talk to us about some of the parallels between when money came looking for people in the late 90s, early 2000s, and obviously what happened with the housing market then compared to reverse mortgages today.
Sure, Ben. That was a period of time where credit was being made overly available without particular regard to the credit qualities or capacities of the people who were getting that credit. It was not uncommon, particularly like in the neighborhoods that Colin highlighted up in the West Oak Lane section of Philadelphia, that area that was shaded most darkly, representing a high African-American population and lots of reverse mortgages. Those are places that were really targeted for these subprime and predatory loans. And people would be, essentially just in their home, and literally these contractors, mortgage brokers and the like would knock on their door, tell them that their neighbor across the street just got one of their mortgages. They would point out how their porch could use a little bit of work or some other work on their home. And before you knew it, the people would be talked into a mortgage that they were not looking for. In other words, the money came looking for them. And we found also in the qualitative interviews that we did in those instances that typically where the money went looking for the individual as opposed to the individual looking for the money, they had actually less recollection and less comprehension of the totalities of the transaction. And I think in many ways that parallel is very on point for what happens with the reverse mortgage borrowers.
And I can't help but wonder, when we're trying to take a quick look at Erie, and I think that in the city in particular compared to the county, many more renters, folks who are renting, not owning their homes. But Colin, and you unpacked so well the impact of that and the disparities when it comes to race. I'm wondering, when this product becomes the next wave of potentially abusive financial products targeted explicitly to modest income Black neighborhoods, what the two of you found there? Maybe Ira, you want to comment on that? Colin, you want to comment on that? Because race is such an important conversation that we're having today, as our country continues to unpack that. Can we highlight that, please?
Sure. Let me take a first cut at it. One of the things I think that makes a Black population, a minority population, depending upon the makeup of the community that you live in, one of the things that makes that so enticing is that you have a population for whom, particularly if they're older in this instance, It's not sort of in their life space to be able to think that it was possible to just walk in the bank and borrow money. It's a population that oftentimes had to deal with finance companies and other than the normal mainstream financial institutions. And because of that, the perspective on access to capital, what you can get, where you can get it from, the terms under which you can get it, is constrained. That constrained perspective, I think, makes people ripe to be taken advantage of in a transaction that's not necessarily to their advantage. Colin, if you want to add something to that.
Yeah, I think that makes a lot of sense. A few of the homeowners we talked to as the qualitative interviews that we did mentioned that they had some experiences at a particular bank, and that in those cases the bank recommended this to them. And I think one of the things for a lot of homeowners was that they relied on someone that they trusted and didn't maybe look as hard into the finances as they could have. So even in some of the cases where they had a lending institution that they trusted, they went on that first word rather than really scrutinizing the effect of the loan overall. And so that's an important thing when you're talking with a lot of seniors, that they're seeing people that they trust advertise this product. They might be hearing from people that they trust that it's a good product, whether those be friends or the bank or whoever. And so it's really important to help them get as good information as they can possibly get.
Is this product inherently American? And that is, is something similar to or an analog to this available in similar countries? And if so, how similar is it? What differences do we see?
Yeah, Ben, one of the things that we've noted, we work with a UK-based foundation, not for this particular project, for others. And as we were sort of discussing this mortgage product with them, what they were saying that this product does exist in the UK, but it's very specifically for very wealthy people, lots of wealth but no income. So you have the family castle, but you don't have enough money to pay your bills. And it is not a product that is generally made available to or accessible to people who are of modest means to make up for income that they don't have at that low level. So it is a product that exists, and it's sort of in a different form, and it's not federally insured in the same way because there is no FHA there. But it is the corollary product does exist, but it's a very different population that makes use of it.
And so one of the questions in the comment section is, somebody takes advantage of this product, but then finds, they're running into a bit of trouble. Who should seniors contact if they have borrowed with a reverse mortgage, but are now having trouble meeting those loan requirements? So they've bought in, perhaps of their own volition and fully understanding, or perhaps through suspect methods, but now they're in some trouble. Where do they go?
I think the first folks to contact are your local housing counseling office and your local legal services if you're already at the point of it being a foreclosure. Legal services folks have done great work with all different situations with reverse mortgages, from helping the senior negotiate with the lender for any kind of repayment agreement if that's necessary, to sometimes working out those issues where money found the homeowner, as Ira described, and being able to be more aggressive about litigating those issues. So if it's come to foreclosure, legal services are the place to start. If it's a financial issue, probably housing counseling is the place to start.
If I could add two others, I would mention one is the Consumer Financial Protection Bureau, to the extent that it's still functioning and taking in complaints and the like. That is one place to look, and they would have authority in this realm. And secondly is AARP has, for a number of years been aggressively involved in trying to understand and work with people who have these reverse mortgages, and making your way somewhere into to AARP, the American Association of Retired Persons, would not be a bad thing either.
So, gentlemen, an hour goes quickly. As we're almost out of time here, I want to look at the fact that we are, up against one of the largest generations retiring, and the baby boomers are now all moving out of the workforce economy, and into retirement. what impact is that going to have on lending processes like reverse mortgages? And I suppose, more simply put, what's the future of reverse mortgages as we continue to move on, look at a big generation retiring, and look at changes happening, particularly with the pandemic?
Yeah, I think there's a gray wave coming, you could say. It's that you're expecting a lot of people to reach that reverse mortgage eligible age in the next 10 years. And if you look at data on how families hold wealth in our country, the home is far and away the number one source of wealth for families in this country. And so those are resources that people are looking for ways to access, and a reverse mortgage is one of the chief ways to do that. So I think you expect that this lending product is probably going to grow in its usage throughout the country, which makes it all the more important for people to sort of understand what they're getting into, and how the commercials might give them, just a little bit of what they need to know, really just the tiniest amount.
Colin Weidig, Ira Goldstein, Michael Norton, gentlemen, thank you for taking the time to join us for this Jefferson program today.
Thank you.
Thank you, Ben. Thanks to the Jefferson.
And thanks to all of you watching along at home. Thank you for tuning in. Colin, I see your information there, contact information on the screen. We're also going to put some helpful information in the comment section on our Facebook page. And since we are recording this event, we'll put this on our website as well. Some frequently asked questions, some documents to hand out. Anything else we need to point them to, Colin, Ira, anywhere else we can guide folks who want to get access to the resource and research that you and your team are providing?
Sure, they can go to our website, which is www.reinvestment.com, and we have a publications page there that has a lot of this information. Or as you said, my contact information is on the slide here. I'd be happy, and on the FAQs, I'm happy to answer any questions that folks have.
Excellent. Thank you, Colin. And for more information on both past and upcoming Jefferson Educational Society programming, as well as publications, please visit our website at jeserie.org. And be sure to like us on Facebook, follow us on Twitter and Instagram, and subscribe to our YouTube channel, where you'll find information about this program and so much more. For the Jefferson Educational Society, I'm Ben Spegan. Be safe, be sound, and thanks for listening and learning with us.